Hey everyone, my name's Andy. My channel's Finding Value. If you find value by getting information about financial education, about undervalued assets, if that about commodities, about anything about markets, to be honest, because I'm going to go over a lot of data here. If you guys are interested in that, subscribe to the channel. Give me a thumbs up for the content, and please leave comments below on anything that you guys have. It could be about this presentation. It can be about, I don't know, a trip that you've done, whatever it is. It helps me out if you guys put comments for the algorithms, apparently. So that's why I typically say that in the beginning of the video. So this is data here. And this is random data that I've seen people ask questions about. So I'm going over a whole bunch of different data here. This is, someone asked, are mortgage rates, do they have any correlation to the 10-year yield? Because I go over the 10-year yield, and my answer is yes, they are very much correlated. And what usually happens is that the 10-year moves first, so the blue line moves first up, and then you'll see a delay in the 30-year just a little bit behind it. So this is basically a mirror, or very close mirror to the 10-year, delayed a little bit, maybe a month or two. So this will move on up, and then you'll see this move on up. And you can see this peaked, and this peaked a little bit behind it. So yes, you can use the 10-year as a leading indicator of the 30-year fixed rate mortgage with a pretty good correlation. It's correlated very well. And you can see that in this chart. This is the buying power equivalent of $100 for the United States dollar here. And in order to remain flat from, I would say, where it really started to take off was in the 30s and 40s. But from over here, this thing has increased a 21x, which that means today, in order for $100 to be in 1799, you'd have to have $2,100 or so. That's a 21x. So in order to remain flat, your investments have to be at a 21x since 1799. And remember, this thing really hockey sticked, I would say, after 1950. So we're living in a world where this is what we know. We know this massive increase or a massive devaluation of the dollar is all we know. And we think that this over here is normal. What I'm telling you is it's not that normal. We have a lot of inflation. Here's the Dow Jones. Remember, we have the dollar that it's priced in doing this the same time this is going up. So in order to remain flat, the Dow has to go up. Then after you pay your taxes, you're going to have some sort of increased purchasing power gains. And over time, it's getting more and more difficult to do that. As the inflation goes up and as interest rates go up, I think that stocks are very richly valued right now. And I don't think the Dow Jones is necessarily the best spot to be over the next maybe, say, 10, 15 years. I think commodities are going to outperform the Dow. And I'm going to show you that in some other later clips here. This is gold. I forgot to write the gold price here, but gold was up 87.5x. So this was up 397. This was up 87.5. I think this is in a massive bubble. I think this is really underpriced. So the Dow to gold ratio, we can see it. Those are the two charts in a ratio format on this presentation here. So we're looking at a ratio. I'd say 10 is kind of a spot where you get above 10, it's starting to get pretty richly valued for the Dow. And right now we are in total bubble land, just below 20. So I think this is going to come back down. I think gold's going to outperform the Dow. And I think you're going to get purchasing power gains investing in gold and commodities. That's where I see the value. This is the gold and Dow Jones priced over time and overlaid. So you can see that when gold goes up, sometimes the Dow lags. And then when gold lags, sometimes the Dow goes up. That's what we're looking to try to identify using ratios. This ratio here is identifying what asset you want to be in. So if you looked at this portion here, we're going to have to go over here. This is 82 to 2000. This is saying you want to be in stocks or the Dow in 1981, 82. So if you look at 81, 82 right here, it's saying you should be in stocks. So stocks went up and then they peaked in 2000. When this goes up, you want to wait for this to turn. It turned, started to head back down. You'd say, wait, you want to be in gold in 2000. And if you look, 2000 is about right here, gold. Then you want to get into gold, and this is the ride up you get. So you ride from 81 up, then you swap here, and then you ride this one up as this goes sideways and doesn't really go anywhere. So what I'm saying now is that I think that we are highly priced here, and I think this is going to head back down, given the valuations, given what commodities are doing, given where we are in the real estate sector. The market conditions, the backdrop, where the wind is blowing is at the back of commodities, not for the Dow. This is price to earnings ratio and long-term interest rates overlaid on one chart. And what you're going to see is the price to earnings ratio compresses as interest rates go up. Then the opposite happens. When interest rates peak and go down, the PE earnings ratio expand. So what you see is in a PE ratio that compresses when interest rates go up and expands when interest rates go down. And if you notice, interest rates have been going on 81. It was a low point. As the interest rate went up, we declined in the PE ratio. And then as we bottomed in price, or I should say in PE ratio, we peaked in interest rates and it reversed. Those PE ratios really started to expand. And what I get afraid of, and why I talk on this channel a lot about interest rates, is that I see inflation from the housing market working its way in. It's going to work its way into commodities. And the stock market is going to come under pressure when interest rates go up. This is just information showing you that price to earnings ratios expand and contract based off of interest rates. And interest rates is a very important thing to understand, because on the channel, I always show you about yields, and yields are going up. This chart here is saying when yields go up, it's going to put pressure on the pricing of stocks. You're going to see a compression of the price to earnings ratio, which means stock prices are going to go down. This is the housing index versus interest rate. I get a lot of questions on interest rates and house prices. If you look at 40s, 42 was the bottom here. We started heading on up. So did home prices. Home prices go up and lead interest rates. So you're going to see this was in a downtrend. House prices started to turn up and interest rates followed. So house prices went up this entire time as interest rates went through the roof. So one could almost say that house prices are a leading indicator of interest rates eventually going up, which they are, in my opinion. Then you can see a peak here, and you can see house prices went sideways, and then the interest rates started to fall. And remember, there's other underlying factors behind interest rates. So it's not a direct correlation, but they are somewhat correlated. And you can see that we did have interest rates fall during an increasing period of home prices. But right now we are so low in interest rates, and I see a wave of inflation coming and a commodity boom overlaid on this, that I think inflation is going to come and interest rates will go higher. That's my take on it. And demographics also support this. This is the ore grades. So I'm going over a bunch of different things that people wanted to talk about in the comments section. We have declining ore grades in copper, gold, lead, and zinc. And you can see that back in the 1800s, everything was above 10%. Then we start going down. Now we're below 5% on some of these. I mean, everything is trending lower over time as we go after lower and lower ore grades in the earth. And what that means is it's going to take more and more energy to extract these minerals out of the ground, because we have to move more earth to get the same amount of materials. And if we're trying to expand production, if we're trying to grow it at some percent per year, we're going to have to move an exponential amount more of earth to get the same amount of minerals or more minerals out of the ground. So it's important to know this and look at perhaps oil demand. So I tied this with global oil demand outlook by location because I know a lot of people, if you're invested in oil, you've got questions about the oil demand going forward. I wanted to look into some of the projections. We're kind of flat to just slightly down in the OECD, the what is that, economic, the first world countries, so to speak, and then the developing countries, the non-OECD, they are ramping up quite substantially. So overall, the demand for oil is going up into the future. This is the king of STEM. I know we had some people ask some questions about engineering and pay. So in engineering in general, if you're 10 years graduate student, 96,000 in general, 144,000 in mining and mineral engineering. Very lucrative here in petroleum engineering at 240,000. That's a pretty good pay. Starting pay is 101,000. That's really good. So petroleum engineering looks like a good spot to be. Bitcoin devours more electricity than Switzerland. So Switzerland, Greece, Israel, Ireland, and then we got Bitcoin swallowing up a bunch of energy here. Just an FYI. Global electric car usage. We've got Norway at 49%, Iceland at 19%, and we've got a whole bunch of countries that can obviously adopt a lot more electric vehicles over time. So there is a big growth sector here, and it's a lot of the major countries that could adopt more electric vehicles. So there is a lot of growth out there for electric vehicles. CO2 in the past, I know there's some people talking about carbon dioxide on the channel in the comments section. CO2 was higher in the past, and I don't know if people know that. The killer, and this isn't my quote, this is a different person's quote. The killer proof that CO2 does not drive climate is to be found during the Ordovician, Silurian, and the Jurassic Cretaceous periods when CO2 levels were greater than 4,000 parts per million and about 2,000 parts per million, respectively. If the IPCC theory is correct, there should have been runaway greenhouse-induced global warming during these periods, but instead there was glaciation, glaciers. So it was a global cooling period with very high levels of CO2. Those levels are probably 10 times where we are today. This is a chart of that. This is where we are today. This is the CO2 level here, absolutely far higher than what it is today in relationship to history. And they didn't have any problems with their Earth at that time. And remember, there's also solar output that we need to look at as well. I don't know if CO2 is as important as most people think it is. I would guess it's not. And that the Earth and the normal carbon cycle, it has more to do with that, and the melting of all of the carbon that is stuck in probably the glaciers and ice and whatnot. When that melts off, it releases carbon into the atmosphere. So there's also that going on as well. Again, I'm not an expert in the carbon stuff. I just found it was interesting, and I knew that the Jurassic period had far higher carbon dioxide levels than we do today. I wanted to go over all these different charts and data because I had a lot of questions in the comments section that I just said, you know what, let's just go over one big chart session here and go over a bunch of different data so you guys know and have a little bit better background just on a very wide array of different information. If you guys like this content, give me a thumbs up. Thank you for listening. This is Finding Value.